Chapter 15 has a lot to do with closing the transaction. The reason that's going to be important to you as agents is because as agents, you are responsible for the accuracy of the settlement statement, sometimes referred to as the HUD1. The HUD1 is going to be a history of where all the money went in the transaction. Yeah, I could lecture you a long time on chapter 15. However, if you just simply know the numbers, you're probably going to come out pretty close on doing well in this particular chapter. When I look at numbers on the settlement statement, what I'm basically looking at is I'm looking at buyer numbers and I'm looking at seller numbers. The buyer and seller will both have debits and credits. So I'm going to create just a very simple chart of how I look at this. When you look at the buyer, he's going to have certain debits and he's going to have certain credits. The seller, similarly, will have certain credits and certain debits. If any of you have had accounting classes, suspend anything you learned in accounting classes, because some accountants have told me that they use the words a little bit different in accounting classes, so just throw that out. Here's what I want you to understand. A debit, when we're talking about this chapter, a debit is something that you're responsible for paying. A debit to the buyer is something he has to pay. A credit, on the other hand, is money that he's receiving. So from the buyer standpoint, a credit reduces the amount of cash that the buyer has to bring to closing. A credit to the seller is money that he could potentially walk home with. A debit to the seller reduces the amount that he's going to walk home with. Logic will apply on probably 90% of this particular chapter. So just relax your mind and see if you can answer the following questions. The sale price on this home is $200,000. The sale price is $200,000. What we're trying to do is account for where the money went in the transaction. So, to the buyer, what's the sale price going to be? A debit or a credit? It's technically a debit. It's his ultimate debit, because that's money he needs to figure out how to come up with at closing. To the buyer, the sale price is going to be a debit. What's the sale price going to be to the seller? That's money he could potentially walk home with. So it's the seller's ultimate credit. Not all items are what we call double entry items. This one just happened to be because the sale price impacts both the buyer and the seller, doesn't it? Okay? Let's talk about something that only applies to the buyer. The buyer is getting an 80% loan-to-value loan. House is $200,000, 80% would be $160,000. The buyer is getting a $160,000 loan. Okay? How do you think the loan is going to appear to the buyer? Is it going to be a debit or is it going to be a credit? It's actually a credit, and the reason it is because it reduces the amount of cash that the buyer has to bring to closing. So I know it sounds weird to say a loan is a credit, but hey, all we're looking for is how much you have to bring to closing. So technically the loan amount is going to be a credit to the buyer. And notice how I said it was an 80% loan to value. Sometimes we'll tell you what the loan to value is. Sometimes we'll just tell you what the loan is and you just plug it into place. Does the loan amount have any effect on the seller? It's just part of the overall $200,000 he's going to get. You know what that bank did? That bank, when they loaned the buyer the money, they said, we're going to charge you a 1% loan origination fee. How is the loan origination fee going to appear? As a debit or a credit? Loan origination fee, I said it was 1%. 1% of $160,000 is $1,600. Debit to the buyer. Again, does the loan origination fee have anything to do with the seller? Not really. Not really, because it's not his loan. Bank also said, well, I'm charging 2 discount points. 2 discount points. How much does a discount point cost? 1% of the loan amount. So therefore 2 costs 2% of the loan amount, so $3,200. Let's talk about some things that are going to be holy in this class when we're solving the settlement statement. When you look at the settlement statement, and I don't have room for all of it on the board, I'm just trying to help you think through this. There are going to be a ton of things on the buyer side. There are going to be always 3 on the seller side. Now there might be more if we tell you it's something that the seller is responsible for charging to the seller, but there are 3 things that are always going to go on the seller side. The seller always pays the commission. The seller always pays the commission. The seller always pays deed preparation. Deed preparation. Do you remember the seller is the grantor? If he's going to sell you something, he should at least pay to create the deed that's going to convey the property to you. And the seller always pays excise tax. Where's Joshua? He was just asking for excise tax the other day, and we finally get to excise tax again. Seller always pays excise tax. Let's go ahead and solve those real quickly. In the problem, I'm going to tell you that the commission is 6%. Now, agents learn to calculate commissions very, very quickly in their careers. However, you do understand commissions are paid on sale price, not load value, right? So you're going to be paid on sale price. 6% of $200,000 is $12,000. Where is that going to show up on the settlement statement? Debit to the seller. Because he always pays commission in our problems. No law, it's just that all our problems will be predicated on that, and that's fairly common. The deed preparation costs $125. Typically what happens is the attorney will call up the listing agent and say, hey, does your seller have someone to prepare a deed for them? And they'll say, well, no, we haven't really thought about it. And the attorney says, well, do you want me to just go ahead and take care of it? And most times listing agent will say, sure, just go ahead. Anybody can do it. It's very simple. The attorney will do it. They're going to charge for it, though. They're going to charge somewhere around $125. Do you see what column I put it in? Does that make sense? Deed prep. You want me to tell you a trick on the exam? The seller pays for deed prep. Who pays for recording the deed? The buyer. The buyer pays to record the deed. The seller prepared it to convey it, but once it's been conveyed to the buyer, he wants to record it to protect his interest in the property. So let's say that recording the deed is going to cost, I don't know what deed recordings go for today. Let's say $48. Does it look like I put it in the right spot? By your debit? Okay. And then, just to remind you, the excise tax, and sometimes I'm old school, so you may occasionally hear me refer to these as revenue stamps. That's actually an antiquated term. The more correct term today is excise tax. Does anybody remember the formula? I told you you didn't have to remember because it will come up later. Does anybody remember what the formula for solving for excise tax was? $1 per 500 or any portion thereof. So take the sale price divided by 500 and charge it to the seller. In this case, 200,000 divided by 500 is $400. Now clearly, this is not comprehensive. I'm just giving you an example of how this works. But let's say that these are the only items that come up. Here's what you ultimately end up doing. You add up the buyer's debits. The buyer's debits in this case looks like it's going to be $204,848. Somebody check me on that if you get a chance. That looks right. And his credits are $160,000. So here finally comes the important question here. The important question is, the difference between his debits and credits represents what? How much the buyer has to bring to closing. In my scenario, and again, not comprehensive, but in my scenario, he would need to bring to closing $44,848. On the seller's side, he had total credits of $200,000. It's not terribly uncommon for the seller not to have a lot of credits other than the purchase price, so that's really not uncommon. Now, obviously, I left a lot of stuff out over here for example, this guy apparently has his house paid off, because if he had owed any money to his bank, he'd have had to pay that in closing, right? But apparently he paid his house off, so he owes $12,525. So we subtract his total credits from his total debits, or we subtract his debits from his credits actually, and that leaves us with $187,475 or something like that. And what does that number represent? How much the seller is walking home from closing with. Okay? That is chapter 15 in a nutshell, right there. If you can handle that philosophy, you're going to be in good shape. Did you see anything there that scared you? Do you recognize that you'll run into issues like this? He who benefits pays. See if that makes sense to you. You know, why is the buyer paying the closing costs? It's his loan. He ought to pay. Why is the seller paying the commission? Well, darn it, the agent sold his house. Okay, so he who benefits typically pays. There's several mantras that you can associate with this that you're going to do fine. Bing, if you don't mind, stop right there. Don't go too far.